Hi, welcome back. Today we're going to take a quick look at the different types of loans and credit that are available to you and make sure that we understand the vocabulary behind each of them. The first type of loan that you can get is what we call a secured loan. And the secured loan is one that is promised with a form of collateral, typically something of value, an asset that can be taken by the bank if you do not pay the loan. So typically the loan is to purchase an item that can be taken away. So something like a car loan, for example, because if you don't pay your car loan, then the bank can do what's called a repossession. They send the repo man out in the middle of the night and he takes the car back from you. Or your home loan, in which if you don't pay your mortgage consistently on time, the bank can do what's called a foreclosure. They can take the house away. When they do that, it's a way for the bank to get their money back when you stop paying your loan. The alternative to a secured loan is what we call an unsecured loan. Unsecured loans lack specific collateral to protect the banks if you don't make a payment. So there's no collateral in an unsecured loan. Instead, it's based on your credit score. So with a secured loan, the bank feels more comfortable with giving you the loan because they know that they can sell an item, they can repossess the item and sell it in order to make money. But in an unsecured loan situation, there's more risk to the bank, so they're only going to make a loan to you based on your credit score. The higher your credit score, the more willing they are to make a loan to you and on better terms. That is, they'll give you better interest rates. So the example of an unsecured loan is a credit card. The things you buy with a credit card are not forms of collateral. Instead, if you don't pay, then the banks can send you into what's called collections. They can have collection agencies come and try and get the money that you owe, or they could sue you, but they're not going to come into your house and take your TV or your couch or whatever it is that you bought with a credit card. Student loans are another form of unsecured loan because you're not promising them something that they can take back if you don't pay. But also keep in mind with federal student loans, you have to pay those, and you cannot get out of them by claiming bankruptcy, which is in a different lesson. You must pay your student loan no matter what. Another type of loan you could get is what we call an installment loan. And with installment loans, you are making fixed monthly payments over a fixed period of time. So you might choose to get an installment loan over the course of 3 years, maybe to buy a car. And during those 3 years, you'll have 36 equal payments that will cover not only the principal amount that you borrowed, but will also pay for the interest that you have to pay on the loan. So these installment loans have a very specific start and end date. The monthly payments are always the same. And those are examples. Typically, we have cars or houses that are built or bought on installment. The alternative to an installment loan would be a revolving loan. And with revolving loans, there is no specific end date to when you are borrowing. You have, instead of a specific amount that you're borrowing for a specific amount of time, the bank gives you a credit limit. They say you can borrow up to a certain amount of money at any one moment. So if you have a credit limit of $1,000, you can borrow up to $1,000, and then you need to make payments. So as long as you're making minimum monthly payments, the bank is happy with you. If you choose to borrow $1,000 and only pay back $600, then you can still borrow up to another $400 before you hit the limit again. The only thing the bank cares about is to charge you interest on your unpaid balance. But you can keep charging and paying off and charging and paying off and charging and paying off for as long as you want with revolving credit. So much like a revolving door, just goes around in circles and circles and circles, revolving credit continues to go on and on and on for as long as you choose to use it. So while your limit may be only $1,000 at any one time, you could borrow hundreds of thousands of dollars over the course of your life. And that's the whole point, is that revolving credit has no end date, and so it can go on forever and ever and ever. Typically what we're talking about here is credit cards. They're the most common form of revolving credit. And so we have two sort of ways of looking at loans that we talked about. One is the installment versus revolving credit, and the other way of looking at it is secured versus unsecured loans. So those are the typical types that you can get yourself into.